Hi, I'm Jed Wonderly with Noble Home Loans, Certified Mortgage Planner. Been in the business for about 19 years, and my focus has been trying to help people get the right loan, the right mortgage for them. And that doesn't necessarily just mean the lowest interest rate, which we get, but it's more about if you've got a lot of money to put down, how much money should you put down? And you know, should it be a fixed rate or adjustable rate? And that depends on the kind of time frame you have and everything. But the most important thing is how much to put down. A lot of people want to put down a bigger down payment so that they can have a smaller mortgage and a smaller overall monthly payment. And that turns out to be quite inefficient. And it's really bad when it comes to creating wealth. Because as you tie money up into your house, you do a couple of things. You have an opportunity cost, which is huge. And if you look at, if you watch episode 3 of how to avoid the most common and costly mortgage mistakes, I'll put that a link to that in the annotations somewhere on the screen, as well as down below in the description. That talks about opportunity cost. It talks about Rule of 72 and time value of money, which we'll discuss a little bit here. But the big thing is that if you've got money tied up in your house, you know, your house is going to appreciate based on what the market dictates it will, not on how much money you have tied up in your house. So you're actually going to decrease the opportunity for return on investment. You're going to decrease your leverage, which decreases your return on investment within your house. And so there's a lot of things that you're missing out on. And even if you say, well, with my smaller mortgage payment, I have more money to invest each month, you're still not going to be nearly where you could be if you kept a significant portion out. And the example that we've been talking about, and that we'll talk about here today, is if we have a $300,000 home and we have $150,000 to put down, why not just put $60,000 down, which is 20%, to avoid mortgage insurance, and then invest the rest. I've got a very special guest with me today. I've got Brian Grantham here. Brian's a longtime friend of mine, and Brian works for a company. He actually has ownership in a company, and his main thing is about helping people invest safely. His investments are private notes, private lending, and they generate a great safe return. I get asked all the time when I talk about, well, if you get a X% return on investment, people say, well, how in the heck where do you get that? Well, one of the places we get it is right here with Brian. So Brian, welcome to the Wonderly channel, the Wonderly Team channel, and I appreciate you being here.
Anytime.
So tell us a little bit, give us a little bit of background about what you do.
Well, I am a Nevada licensed and bonded private hard money lender. I'm a principal at Mojave Capital. I've been in the private lending world for about 10 years. Worked for various companies around town, and then have been licensed as a broker for it was initially 2006, and then of course the market crashed, slows everything down. 2009 got back going full steam, but as Jed has mentioned, we focus on well underwritten, short-term trust deeds, first position loans that oftentimes, they range between about an 8 to 12% fixed interest. More often than not, you're able to make about an 11 to 12% annual rate of return, and that's fixed interest, so it's monthly dividends back in your account per month. But
so Brian,
that's my background.
Brian, there's let's clarify a couple of things for the people watching. So first of all, when you say hard money, some people might out there, in YouTube land, might be going, "Ooh, hard money, that's scary. I'm going to lose my investment because people have bad credit and they won't be able to pay it back." And explain a little bit about why your investment is typically very safe.
Well, Jed, you're exactly right. Hard money does sometimes get a negative connotation to it. All hard money is it's money that's collateralized by a hard asset. That's all that it means. If you really want to break it down, a mortgage is the exact same thing. The mortgages that you write, the mortgages that you're getting it's all the same. The difference is you've got conventional lenders that are collateralizing by a hard asset, where private money collateralized by a hard asset. With hard money, it is more expensive, so borrowers are going to pay more for it. But there's a reason why they pay more for it. And it's not always that they have bad credit. Most of the time, why a person is willing to pay more money for private funds, such as what we loan, is because they can't go to a bank, again, not because of credit, but because of the type of loan. These are developers, builders, house flippers, real estate investors, who maybe have great credit, great assets, but banks just don't simply move fast enough, nor have banks cut out a piece of their portfolio for this type of investor. As you know, banks want 30-year fixed mortgages. Mm-hmm. We want 3-month to 12-month mortgages. That term mortgage can be used universally between these two investments because that's exactly what it is. It's a short-term mortgage, just like what you're doing all day long. We're just doing it for investors instead. And so we're also able to loan, because these borrowers have more assets and more cash, we're able to collateralize a lot better. And the fact that we're able to loan maybe 50% of what a property's worth. So for example, that $300,000 house, we might only loan $150,000 towards that home. So now we've got an asset that's collateralizing this loan that's worth $300,000. That we're only loaning $150,000. We're collecting a 12% interest rate that passes on to our investors. So naturally our security is significantly high because, especially in today's market, we've kind of bottomed out. I think you're comfortable with that. Things are starting to move forward. Yep. We've got collateral that in most cases is appreciating. We've only loaned around 50% on. We max out at 70%.
Right, so you still have a 30% bumper in there.
Worst case.
Now, if you out there in YouTube land, go ahead and click on the link so that you can see episode 3 of how to avoid the most common and costly mortgage mistakes. You'll see that I discuss things like the rule of 72 and time value of money. And in the rule of 72, if you take 72 and you divide it by the rate of return that you expect to get, then that gives you the number of years that you would expect your investment to double. Now that's based on compound interest. So let's, for instance, let's take if you were to invest with Brian and get 12% return. Now let's use that $300,000 example that we're talking about. If somebody decided, well, I've got $150,000 to put down, but I'm only going to put down $60,000. I'm going to invest that other $90,000 with Brian. What happens then is that 12% return is going to generate 12 times 9 is 108,000, or is 108. So in the case of 90,000, 12% is going to be $10,800 that you would get over a year's time. So you divide 10,800 by 12 months, and that's the interest payments that you're going to receive. Now the key thing to understand is that you're not supposed to spend those. You're supposed to save those up, and then when you get back your $90,000 in principal, now you have $100,800 to invest next time. And that, Brian, we were talking about compound interest off camera recently, and that's what really makes that rule of 72 work, because now you've got more to invest. You're reinvesting that. Now they're investing a little over $100,000 with you on the next time.
Correct. And
that just continues to grow. And so if we look at what the 90,000 can become, at 12%, it's going to double approximately every 6 years, actually a little bit less than 6 years. So if you take 90,000 in a little bit less than 6 years, we'll just call it 6, that's going to become 180,000. After 12 years, that's going to be 360,000. After 18 years, that becomes, that 180,000 becomes now 360,000, and then 720, then 1,440,000. So after 24 years, that 90,000 that would have done basically nothing for you in your house now becomes 1.44 million. And even if there's a month or two where you're not invested, you're waiting for the next thing to come along, you're still going to be pretty close to that timeline and to that dollar figure. And then if you want to pay your house off, you can. But the nice thing is that you can have that money and you can be well invested, and you've got choices because of how much money you have. Now, Brian, one of the things that you talked about when we were discussing this initially is I told you that I really like tax planning and the ability for people to account for how high taxes are probably going to be years down the road because of the significant national debt that we have. And you said that one of your favorite ways to help people with these kind of investments is either through a Roth IRA or a 401k. Now the Roth is great because if you've got a significant Roth IRA, you could put some of that $90,000 in a Roth IRA, a self-directed Roth, as Brian will talk about, and that's going to help you grow money tax deferred. And in the case of a Roth, when you pull it out, you're not going to have any taxes on it. So Brian, talk a little bit about how that, most people don't know what a self-directed IRA is.
I found about 10 years ago there was a niche of investing. Everyone has their 401k at work. We have our IRAs that we roll our previous 401ks into. Those of us that are smart enough go get a Roth and set up one of those so we can hopefully eventually not pay taxes, or we convert to a Roth. Well, I use companies called trust companies. Trust companies are self-directed IRA custodians. There are many around the country. I can discuss specific ones and which ones I would prefer at a later date. But these trust companies are, again, they're self-directed IRA custodians. So in that, these self-directed accounts free up what you're able to invest in. You're not locked in strictly to the stock market.
Or mutual funds or anything
stocks,
else like
bonds,
that. They can
mutual
actually
funds.
do something
Correct.
with you now.
You now have the freedom to invest in literally anything you want to. You could buy real estate with it. You can invest into businesses directly as capital contributors. You could invest into your own business. You could invest into first trust deeds. It's easier to say the things you can't invest into than it is to say the things you can. The IRS frees these accounts up to be able to do what you want to. So now you're able to get your money out of the stock market and invest it into higher earning, lower fee investments that are going to return to you a more steady, fixed, higher return. So you can pay less tax now, and if you're using a Roth, pay no tax. Now, well, pay it now, not pay it later.
Right. Pay it on the seed as opposed to the harvest.
Correct. There's also a vehicle that I use for anyone that owns an LLC or that owns a business that doesn't have employees. So if you are a self-employed individual, there's something called a solo 401k. Don't know if you've ever heard of it or if any of you have. A solo 401k is a self-employed 401k. You set it up underneath your own entity and it's self-directed. It can be both Roth and it can be traditional. In fact, there's a traditional bucket and a Roth bucket inside the same exact account. With this, you get all the benefits of a 401k inside of your own business. You also get the benefit of self-directed investing, being able to pick and choose what you want to invest in. And your contribution limits are significantly higher. To the point that inside of an IRA, you're about $5,500 or $6,500.
Exactly. So just for those of you wondering about limits, up until 50, I believe it's 50 or 55.
Age 50, it's
Age
$5,500 a year.
$5,500 a year per person. So if you're married, you could invest up to $11,000 into a Roth IRA. One for you and one for your spouse. Whereas once you hit 50, then you can invest $6,500 per person, so a total of $13,000 for a married couple.
Correct. And then the solo 401k, your contribution limits, you get to contribute both as the employer, because you own the LLC, as well as the employee, because you work for the LLC even though you own it. Your contribution limits as the employer are about $25,000 per year. that you can contribute. And then as the employee, again with age, there's a catch up with that as well. It's $17,500 plus $5,500 if you're over age 50. So with that, there's some additional contributions that you can make as well in addition. Your total contributions are around $50,000 per year that you can contribute tax deferred to your retirement account by using a solo 401k. So now, take it one step further with that $90,000 you're talking about. Instead of putting it into a mortgage where you maybe get inflation, depending on what the market's doing, you could put it into a retirement vehicle, Roth, get that tax-free, contribute most of it, not all of it. If you split it up between you and a spouse, you could contribute all of it to your retirement account and continue to grow tax-deferred or tax-free all of that money.
Which gives you a true return on investment of whatever you're getting when you invest with Brian, because you don't have to then subtract out any capital gains tax or anything like that even when you're cashing out of investments because of the tax deferment. And like we've talked about with the Roth, when you start pulling it out after age 59 and a half, and I personally prefer, you can keep it in, you don't have to start withdrawing it until the April 1st after you turn 70 and a half. Then you have to start making mandatory withdrawals. But, to me, that's you leave it in there and you just let that puppy grow, and when it's invested in something that's safe and relatively liquid as opposed to being in your house, just like we talked about earlier in the example, it's $1.44 million after 24 years. The next doubling period, Brian, takes it up to almost $2.9 million. So if you delay your investing strategy by 6 years and you have $90,000 to invest 6 years later, then you've cost yourself $1.44 million because you've missed out on that doubling period, which is why the time value of money is so important, and getting it invested now is so important, as opposed to saying, well, I'm 25 or I'm 30 or whatever age you are, and you say, well, I've got plenty of time to invest. Just think about the cost of that decision. And what I would tell you is that if you would like to see some numbers that apply specifically to you, please feel free to call me at 702-812-1214. That's 702-812-1214. And I can show you some of the spreadsheets that I've developed and run those numbers for you so that we can go ahead and really help you understand the kind of retirement, the quality of life you're going to be able to afford because of that, 20, 25, 30, 35 years down the road, just depending on your age. And Brian, why don't you give them your number so that they can contact you to learn more about the investments you have to offer.
Okay, again, my name is Brian Grantham, and it's Mojave Capital. You can reach me on my cell phone, would be the easiest. That's 702-581-1181. Again, 702-581-1181.
And that wraps up this episode, and appreciate you watching it. Again, I highly recommend watching episode 3, which is going to give you a little bit more background about time value of money and rule of 72 and leverage and some other investing principles. And then once we meet in person, you're going to hopefully see a lot of opportunity that you have, as long as you don't bury that opportunity and absorb that opportunity cost by putting it into your home. Thanks for watching. Please like, share, and subscribe, and look forward to meeting with you in person. Have a great day. Take care now.